Good afternoon. Today we're going to pick up where we left off in chapter 14. This table is a couple things, but we're talking about the sales and collection transaction cycle comprised of two significant classes of transactions: credit sales, pink; cash receipts, yellow. A couple of things. One thing that this slide is trying to show is that assessing control risk as low is not as easy as it sounds. So for each significant class of transactions, we're going to have to assess control risk for each and every objective. In our case, the objectives are, we link them to the assertions. So in this little example, we've got 5 significant classes of transactions. That means we're going to have 30 preliminary assessments of control risk. Now, whenever we assess control risk as less than the max, in Ted's world, it's either low or high, but in the real world, it can be any place in between. But wherever we assess control risk as less than max, we're going to have to identify specific control activities that ensure that assertion is satisfied, and then we're going to have to design tested controls to make sure that control activity is actually working properly, and then we're going to have to evaluate the results of those tested controls. We're talking about sales and collection cycle. The pink slides are credit sales. This is one of my favorite tables in the book. Look down the left-hand column, and we're going to see occurrence, completeness, and accuracy. And they're going to go into a little bit more depth. So you're going to change occurrence to an objective. Recorded sales are for shipments actually made to non-fictitious customers. Completeness, they're going to change into an objective. All existing sales transactions are actually recorded. Accuracy, change to an objective. All recorded sales are for the correct amount of goods shipped, and they're billed at the correct price. So I'm going to suggest now the left-hand side of this table relates to tested controls. The right hand that's hidden under the gray is substantive test of transactions. It's all transactions. So you can see at the top where we're talking transactions. Most, not all, but most tested controls are related to transactions. So I suggest you pick 2 or 3. So for occurrence, it says the key control is that sales are supported by authorized shipping documents and approved customer orders. So what they're saying is they won't record a sale unless there's an invoice, that there's a corresponding shipping document, that there's a corresponding sales order, and that there's a corresponding customer order. Kind of similar to the Vouch and Trace project, only here we're not going to worry about the dollar amount. We're going to say, did they follow the procedure? Okay, and so we're going to design a tested control. We're going to take a sample of 10 items from the sales journal, make sure there's a corresponding invoice, corresponding shipping document, corresponding sales order, corresponding customer order. Pick 3 or 4 and make sure that they make sense to you. Completeness, shipping documents are pre-numbered and accounted for weekly. So we're going to pick a couple weeks and test their accounting for the sequence of shipping documents. Do they actually do it? Accuracy. Batch quantities are compared with the quantities billed. So we're going to take a period of time and examine the batch totals and make sure they agree with the quantities that were actually shipped and billed. Okay. They also say that their selling prices come from the master sales list. So we're going to take a sample and make sure that they do agree with the prices on the sales on the master price list. Okay. Now, while we've got that sample of 10 transactions, we're also going to perform substantive tests of transactions. Now, we have to do some substantive work in this case, and a little bit more than limited, because they've got a deficiency. There's no control in place to prevent sales invoices from being recorded more than once in the sales journal. So it would be possible that somebody would enter the same sales invoice in the sales journal more than once. They don't have any control that would detect that. So over in the far right column, we're going to perform a substantive test of transactions. We're going to use the same sample of 10 transactions, but in this type, instead of seeing did they follow the procedure correctly, we're going to say are the dollar amounts correctly. We're trying to validate that the dollar amounts are correct. So we're going to vouch 10 entries from the sales journal to the supporting invoice, make sure the information is the same on the invoice as the sales journal. We're going to vouch to the shipping document, make sure the information is the same on the shipping document as the sales invoice. And we're going to vouch to the sales order and the customer order. Again, don't memorize this, but I just want you to walk through 3 or 4 and make sure you understand how they achieve the objectives. Vouching and tracing are nothing more or less than direction. Vouchings from the general ledger or sales journal to supporting source documents. Tracings from supporting source documents to the general ledger. I think of tracing as going forward. We simply go from the customer order to the sales order to the shipping document to the invoice to the sales journal to the general ledger. So tracing just follows the direction of the transaction. Vouching, on the other hand, I think of as going backwards. We start at the general ledger, we go to the sales journal, we go to the invoice, we vouch to the shipping document, we vouch to the sales order, and then the customer order. Now, notice a change from pink to yellow because now we're still in the sales and collection cycle, but now we're going to talk about cash receipts. Significant class of transactions, cash receipts. That's the yellow line. And again, I've got 6 assertions and 6 audit objectives related to cash receipts. I have to assess control risk for each of those. Whenever control risk is less than the max, then I'm going to have to identify a control activity that makes sure that all recorded transactions actually occurred. Going to have to design a test of controls to see if that procedure is actually effective and evaluate the results. Now, again, we've got on the left-hand side occurrence, completeness, accuracy. We're talking about transactions. This is a little different. Notice the weakness over there. Pre-listing of cash is not used to verify recorded cash receipts, so that's a weakness. You can read what it said, but the 800-pound gorilla with cash receipts or any cash account is the bank reconciliation and the proof of cash. So the bank reconciliation, you learned it. Get the bank statement. It says we have $109,000. The general ledger says we have $32,000. I have to reconcile that. I go through and to the bank statement, I had $21,000 in deposits in transit. These are deposits that were in transit as of December 31st, and the bank did not process them until January. Similarly, there's going to be a bunch of checks somewhere in the mail, 87,000 in this case, and these were in the mail. The bank had not received and processed these checks, outstanding checks. And then the bank made an error. That's pretty unusual. So the correct balance should be $28,168. My general ledger balance is $32,584. I've got a service charge, and there's a customer check that bounced. It was a check that didn't have sufficient funds. So we all learned the bank reconciliation somewhere in 214 or 321, hopefully. And a proof of cash is just a heavy-duty bank reconciliation. Some people call it a four corners bank rec. So the right-hand column is the 12/31 bank reconciliation, the date on the balance sheet. So this is 12/31 of the current year. The left-hand column is 12/31 from last year. Now I'm going to walk across, hopefully it's obvious, just the top line there. The bank said we had $115,000 last year on 12/31 last year. They accepted deposits of $912,000. There were withdrawals of $907,000. The ending balance is $120,262. Let's do that again for the general ledger. So we'll go down toward the bottom. Last year, the general ledger said we had $109,000. We had cash receipts of $917,000. We wrote checks of $904,000, and the ending balance for the general ledger is $121,000. So I'm going to reconcile those just like we did on the previous slide. But the beauty of the proof of cash is now I can reconcile deposits per the bank to cash receipts per the book, or more correctly, cash receipts per the book to deposits per the bank, because the bank statement is good third-party evidence. In the simplest sense, all I have to do is adjust my deposits in transit. Now, last year there were $21,000 in deposits in transit. Those were recorded in the books last year. They didn't clear the bank until January of this year, so we have to subtract those out. Similarly, on December 31st this year, we've got $26,000 in deposits in transit that have not yet cleared the bank. So we have to add those to the deposits per the bank. And you see, now I can reconcile cash receipts per the book with deposits per the bank. This is good, heavy-duty, third-party evidence. For a small or mid-sized client, I should be able to reconcile or calculate what my sales are. I take that formula, ending accounts receivable plus cash receipts minus beginning accounts receivable equals sales. I may have to make some adjustments. They may have some cash receipts that aren't related to sales, but that shouldn't be too hard to work around. One last thing, make sure you can differentiate planned detection risk from achieved detection risk. In the planning phase of the audit, we determined that planned detection risk needs to be low. Okay? But that doesn't make detection risk low. We have to go out and perform substantive procedures to reduce detection risk to an acceptably low level. So we've got planned detection risk in the planning phase of the audit, and we have achieved detection risk at the end of the audit. Make sure those concepts are clear in your mind. At the beginning of the audit, before we performed any audit procedures, the achieved level of detection risk is 1. Okay, actual achieved detection risk doesn't go down until we start performing audit procedures. Now we're responsible for all 6 of the assertions related to account balances. Tad's 2 favorites are still existence and completeness. I always start and say, does this procedure or does this problem relate to existence or completeness? Because they're pretty much opposites. So that's where I start. If it doesn't relate to existence or completeness, then I say, does it relate to accuracy, valuation, and allocation? That's kind of my third favorite. Okay. If it doesn't relate to any of those, then I look at classification, rights and obligation, and presentation. On the final, you'll be responsible for all of them. There's probably close to 100% probability there'll be questions related to existence and completeness. There's a high probability there'll be questions related to accuracy, valuation, and allocation. Okay. There will be questions related to classification, rights and obligation, and presentation. The probability of any one of them is not near as high as the top three. But I'm going to ask something to keep you honest. Make sure you at least studied it. Tomorrow we're going to play what I call the first or last game. Are you more concerned about the last 25 transactions in 2021 or the first 25 transactions in 2022? Thank you and have a nice day.